When you're using a system to trade stocks, you use what's there, and you can be fooled into thinking you have a system when you really don't. Like I was when I started about over 10 years ago in 2007. I was planning on trading and finding a better way to, a better method, a better technique, a better procedure to improve my inconsistency, because I would be profitable on one trade and not profitable on the next, and it would go back and forth like that. I just had no control over keeping it, profitable every time. And that may be true with what you're experiencing. But one of the things that we knew that we had to do was create a system, because when I was trading, I would then build a couple new indicators, or maybe 5 indicators in a week, and think I had a better system. But I did not have a better system. I just had more indicators. But I was thinking I had a better system. And I also knew that I also knew that it was much more important, and I'll ask the question this way. I'll say, what's more important, the next trade that you make, or the system that you use to find the next trade that you make? And that leads us down a pathway, why did I not stop trading and develop this system and then start trading after my system was developed? I knew the system was much more important than the next trade I was going to make, because with a good system you will then pick much better trades. I was confident enough that I could risk money and do that. And each of us are that way. We can do things and continue down pathways that are, we're all a little bit proud, and we think we can solve the problem by by ourselves. And so that brings us to one of the things that we decided we had to do in order to make the system effective. Number one, we had to build a long-term trend line, and that's a single blue dash line on the candle chart. But that wasn't the important line. I mean, that's a exponential average line that we use to determine the long-term trend. We also knew that we had to build a short-term trend line. And as we were doing this, we ran down several different pathways to see which one was the best. We ended up on 3 different pathways, spent a long time trying to determine and figure out how we could incorporate those 3 into one line, like we had done with the long-term trend line. And finally, we stopped that process and decided that the 3 lines were better, because they gave us, with the 3 lines, it gave us far more information than we could get by consolidating the 3 lines into one line. It was like you killed some of the aspects of the other lines, or the other methods of determining the short-term trend. And so we now have a system with a short-term trend, only the trend is in 3 groups. And the trend is basically defined on 3 different charts. This is the trend chart, and the 3 groups are the trend trio, blue, pink, and yellow, that you see here on the trend chart. Down in the power chart, we have the power orange and power green. And over on the swing chart, we have swing red and swing green. Those 3 groups, those 7 lines form the short-term trend within the system. And the first thing we look at is the short-term trend when we've identified a pattern and we're contemplating the good conditions that may or may not be in the pattern. And so the trend trio is faster than the other 2. The trend trio will start going up before the other 2 and start going down before the other 2. And that in itself gives us a lot of additional information that we can use ahead of time. We also use the let me explain this first. In the trend chart, we have red, green, and gray, and they are the 3 lines that down touch the other lines, like the blue, pink, and yellow, and the 0 line. And then, of course, we have the red, like here, it crosses underneath the 0 line, and the next day it goes back up. And the situation that we found ourselves in the creation of these 3 groups was that it became obvious that we could pick up more information using the 3 groups rather than one line. The fast lines, the red, green, and gray on the trend chart are the three lines that identify pullbacks and rallies and this type of thing, quick movements within the system. The short-term trend lines do not do that. They're a little bit slower than the obviously than the fast lines. You can see just by looking at it, trend blue, pink, and yellow are continuing to go up, and in this case here, trend red has started back down. This is the first day that it's going back down. So, and it might be a good idea if I create a line when I say that this is the first day. So this, moved that line wrong. This is the first day that trend red is going down, but blue, pink, and yellow are still going up. And so when we have different patterns that are there are 23 patterns up and 23 patterns down. When you pick a pattern within the pattern types up, you would like to see the short-term trend lines going up, because you're likely to get a bigger candle if that happens. And there's other situations like this that create better price movements based on which way the short-term trend lines are moving. The price, when, for example, the trend trio is above 0, the price has a tendency to move up just because it's above 0. Likewise, when it's under 0, it has a tendency to move, price has a tendency to be flat or move down if the lines are flat. Over in the swing chart right here, the swing red is highest. Between swing red and swing green, it's always highest, and they never cross. Swing red never crosses green. but yet both of them will cross zero. And these three different formulas that track the short-term trend are an effective way for us to identify that trend. And as a result of us leaving the three groups operating obviously independently by themselves, it just gives us more information relative to what's happening in the way of market forces or market pressures within the stock. How high or how low are they in relation to zero? And of course the humps that you see. Like for example, if I expand this a little, we see that blue has a hump right in here, and blue has another little hump right over in here. I just happen to see this. I'm going to point this out. As you can see, the right hump is less than the left hump, and it's also smaller. And you have a red peak over here in trend red, and you have a lower red peak over here in trend red. But the price is higher on the right side than it is on the left side. And that's what we refer to as price divergence. And when we get price divergence, we obviously get a strong down movement, or excuse me, because the pattern is this way. When you have price divergence, it can be up or down, but we know from the patterns that it's down, because this by definition is is a basic downtrend move. And when you have a lower high, like this right here is a lower high compared to this over here, that's the definition of a downtrend. And so even though we had price go up, we recognize that we're starting into a downtrend right here. So divergence is a big factor. If you're not familiar with it, the DTVB system is built on identifying strength. We look at price recognition, or excuse me, price reversal recognition identification. In other words, we look for cycle tops and cycle bottoms. Some people will say a high cycle or a low cycle. And we look for strength. We can identify strength in two different ways, and that is through indicator line length and through divergence. When the system also has the formula. This is with patterns, conditions, and signals. One of those 23 patterns that we've identified can be found just by definition. You can look them up and you can find them. That you then can find those patterns with good conditions, and you can use those specific stocks to take positions in, because there's a high probability that they're going to go exactly as or in a very high probability anticipated price direction that has been historically determined previously from the exact same or very similar conditions within that specific pattern. All that being said, the very first thing that we look at when we're looking at good conditions is the short-term trend lines. If you're looking at a potential movement up and all your short-term trend lines are under zero and going down, it's not too good of an idea to enter a position like that. Obviously, if you're in a normal trading format. If you're a gap hunter and you're searching for gaps, then of course you need to use the three gap patterns, identical indicators, the down touches in the trend chart, and the proximity group patterns, both location patterns and shape patterns. And each of those three have conditions are conditional requirements that are mandated, and if all of those conditions are met, then the basic format for a gap up is there, and gaps will occur with the required conditions met. There are three types of conditions. Those required conditions, like I just talked about. For example, if you take, there's a pattern named red spike. It's basically zip red down under 50 and zip yellow down and above 50. And that reacts, it's a reversal reaction like all of our patterns are, and it goes back up. And that pattern works great if some of the lines are going up, especially if that pattern is discovered when the trend trio has, the blue, pink, and yellow have turned and started going up. Now, with that in mind, the short-term trend lines are the key, or excuse me, they are the first thing that we examine when we're looking at a potential, taking a potential position in a stock. We want to know where they're at. There's a lot of the other things, other conditions, this type of thing. The second, though, you've got conditions that are requirements, you've got conditions that are defined as good conditions, and you've got conditions that are defined as extra or supporting evidence. Excuse me. Good conditions are, for example, the 7 short-term trend lines going up when you have a red spike, because you're likely to get a nice green candle next day because the trend, the short-term trend, is going up. The difference between picking the right position versus a poor position is based on those good conditions. In the rules, indicator rules, you will find the basic pattern rules for each pattern. And under supporting evidence, there is a list of almost 30 different items that are good to see and listed in that document that could be there when you have a nice next day up or an uptrend or a gap up. Most of the time when we're talking about gaps up, we're looking for additional supporting evidence. In all types of trading, I mean, whether you're looking for a one-day movement, a next day up, or you're looking for an uptrend, which might be a 2 to 5 day uptrend, or you're looking for a gap up, the basic idea is the same. We try to find as much additional information that will give us or suggest to us that the pattern will be stronger that day. And obviously we find it in indicator line length and divergence. Indicator line length can be as simple as something like a BOC pattern. That's a bottom of cycle pattern. It's a V-shaped pattern. You got a left leg and a right leg. When the right leg is longer or higher than the left leg, it's called a BOC higher pattern. It also has more power in it, more strength in it, and the following day or days after that will likely be stronger. I don't know what obviously it varies every single day, but if there's a annual average, we might be able to identify somewhere between 10 to maybe 25% of the stocks each day that would have more strength to them in the anticipated movement. Some days it might be 5%. Other days it might be closer to 50%. It's just going to depend on the day and can depend on the conditions that we're dealing with on that day. But the point I'm trying to make is that we can find a significant number of stocks with power or with strength in them to trade each day. And the short-term trend is one of it is the number one thing that we look at before we look at any other types of patterns that might exist, or leading indicators that could be there, or whatever the case may be. So that's a brief description of what the 7 short-term trend lines are, and I gave you a number of other things that surrounded the short-term trend line just by example, so that you can relate to how and why we built the short-term trend lines. So it's an amazing system. If you haven't had a chance to listen to all of the videos on the top videos to watch, that's the very first place to start, and or finish up if you haven't. If you looked at a few and then went on to something else, go back to those, because by the time you get done watching all those, you'll have a really good feeling of how the system works.